Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 8th of April. I'm Daniel Lam, your host for the podcast. It's always interesting to look back at times to macro predictions that the street was making and how they eventually played out. I was presenting at a client seminar last week in Singapore, and we talked about how many were predicting a US recession would happen last year, but that has not happened yet. In fact, the past week brought a series of positive US economic data, all suggesting that conditions remain robust and a recession is not imminent. Now, the ISM manufacturing PMI crossed into expansion for the first time since September 2022. The number of job openings ticked up in February, and non-farm payroll last Friday was strong. Now, the NFP in March increased to 303,000, which was well above consensus estimates of a moderation from 270,000 to 214,000. The payroll numbers for the prior 2 months were revised higher. The participation rate rose. The unemployment rate ticked down slightly to 3.8%, while average hourly earnings growth accelerated from an upwardly revised 0.2% month-on-month to 0.3% month-on-month in March. As a result, the US Economic Surprise Index has been trending higher over the past 3 weeks after having dipped over the prior month. Now, similarly, the Atlantic Fed GDP Now model has the first quarter GDP growth tracking 2.5%, up from a low of 2.0% in the middle of March. However, if you look at the reaction from the asset classes, they were mixed on Friday. Now, the two pieces of price actions that caught my eye were the S&P 500 index up more than 1%, but it did not recoup the losses earlier in the week. And also the DXY index that initially popped upon the announcement of the NFP, but gave up its gains for the day soon after. Now, putting these together, to me, it is a sign of rotation for the assets. So, for example, from US dollar into other currencies, and also sector rotation within US equities. So that was what we've been discussing in the podcast on the 3rd of April, that investors should be fine-tuning their US equities exposure. Expectations is quite elevated for the US growth sectors such as technology and communication services in the first quarter earnings. And there could be short-term healthy pullback there. There could be subsequent fund rotation as a result into sectors such as US energy, which we upgraded to overweight in our latest global market outlook, and it is an opportunistic buy. Now, we believe it acts as a hedge against sticky inflation and also a potential Donald Trump victory in the US elections. Now, year to date, the tight global demand and supply for oil is certainly another supportive factor. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.